Hello and welcome to the National Lunch and Learn League with Annie Mac Home Mortgage. My name is Russ Fitzpatrick, and I believe our realtor partners deserve more. I believe that Annie Mac Home Mortgage does provide more. And I think that if we're going to work together during a historic transitional market with rising interest rates and catastrophic inventory issues, meaning that the inventory of single family homes, the inventory of move in ready homes, is at unprecedented lows, especially compared to the demand. We're going to have to come up with new and different ways to serve our real estate partners and find consumers in this market that are looking to make moves, looking to relocate, and looking to invest in residential real estate. So today, we want to talk to you about multifamily magic. We're going to be talking about income properties, high equity sellers. Some of them are sitting on the highest equity positions they've ever held in their personal lives. The LLCs that manage these income properties, these duplexes, quadplexes, sixplexes, eightplexes. This reality here is that many of those properties have doubled in value in the last 36 months. And if you look at Airbnb revenue in most markets, I know there's some seriously undersaturated markets for Airbnb, but there are a lot of oversupplied markets for Airbnb right now. The elite property managers that I know are facing compression in the Airbnb revenue. Interest rates are expected to rise again. So we haven't seen the last of high interest rates. And election years are notoriously volatile for all markets, but the housing market is much the same. So we're going to be introducing some new products from Annie Mac Home Mortgage that are investor friendly financing. And I want to just focus for just a moment on those thousands and thousands of frustrated home buyers and take their traditional home shopping perspective and start to look at duplexes, quadplexes, and triplexes, start to look at some of the units that are currently being Airbnb'd and saying, hey, can we as real estate professionals find some more listings by focusing on specialization, by expertise and focus? The other thing we're going to introduce today is a new product that Annie Mac is managing. Your local mortgage professional has some new products that we're going to introduce to you that are special for financing self-employed individuals, potentially a young family who couldn't qualify for a duplex or a triplex or a quadplex could actually qualify with some of these new financing options from Annie Mac Home Mortgage. So we are on a mission to grow your revenue. That's what we're on a mission to do. I want to introduce two unique selling propositions for home sellers, and I'd like you to think about being a home seller in Virginia Beach that owns a triplex that doubled in value in the last 3.5, 4 years. Okay, so I bought my triplex for $195,000 back in 2005. Today it's worth $900,000. Okay, and empty nesters, semi-retired, that certain age group that are closer to the winter of their years, they really can liquidate these duplexes, triplexes, and quadplexes for the highest price if you can close, let's say, before October. So we use in Blue Ink a number that's 4 months out. And we talk to sellers about the fact that, hey, interest rates are rising, homeownership affordability is becoming an issue, the election year is coming up. We've got a situation where Airbnb revenue is going down in a lot of markets. And hey, if you're interested, we can sell your Virginia Beach triplex for the highest price if you can close before October of 2023, right? Any date that's 4 months out represents the unique selling proposition. if you live in Orlando, Hilton Head, New Jersey, near the shore, and you've got Airbnbs all around you, let's start thinking about those Airbnb owners as listing prospects. We will sell your Hilton Head Airbnb for the highest price if you can close before October 2023. The reason for that is simple. You've got the highest equity position you've ever had. Here are the reasons that you could sell it for the highest price by October. Interest rates are expected to rise again. Election years are notoriously volatile. We've got some very specific friendly financing available right now through Annie Mac Home Mortgage to help thousands of frustrated home buyers that came to us looking for a single family home. They came to us looking for a single family home, but when we showed them what multifamily magic could do, we're helping traditional home shoppers that are trying to buy their first single family home. We're saying, hey, instead, why don't you think about buying a duplex, triplex, or quadplex? And potentially making a compromise during years 1, 2, and 3, so that in year 4, you can come back and buy that single family home when the interest rates are back down. But your tenants in the duplex and quadplex are going to help pay for the mortgage on something that you would otherwise not been able to afford. We think that's creating generational wealth. We think realtors are serving some of our emerging families that are home shoppers that are right now out shopping, but very, very frustrated by the single family home market. And that's why we believe we could sell your Virginia Beach triplex for the highest price if you can close in the next 4 months, or your Hilton Head Airbnb for the highest price if you can close in the next 4 months. And this applies to every community in North America. If you're not new to Annie Mac Works, if this is not your first lunch and learn event, then you're very familiar with our source of business charting. We are very, very interested in finding several sources of transactions to form a balanced business plan. I'm a realtor for 37 years. I've helped thousands of realtors generate sustainable 6 and 7 figure incomes. And the way that we do it is by working multiple sources of business. And the secret to our success is never projecting an extraordinary result from any one source. So if you look across the bottom of your screen, this realtor is going to work the expired listing market for $1.2 million, Hero Benefits Network for 3 to 4 sales to heroes at 1.2, his subdivision farm area, which he usually sells about 4 houses a year. Those 4 houses at 350 a piece equal another $1.2 million in projected revenue. He's a member of the Opt City and Redfin networks. He's getting involved in a company called Home Hunt for referrals that he takes from lead aggregate companies. He pays a little bit of a referral fee on those, but he knows he can do another $1 million a year, about 3 sales a year from the referrals that he receives. And then he's got this unique selling proposition called eBowl, every buy owner lists, and it's for sale by owners. So when you look at a transactional source of business chart, you start to say to yourself, if I work 2 hours a week with for sale by owners, or if I time block 2 sessions a week with my expired listing campaigns, if I block off a couple hours a week to work with my Hero Benefits Network, cumulatively, that might be a 6, 7, $8 million business plan, but no one source of business is producing extraordinary results. Rather, these are results that are probable and likely even in today's challenging operating environment. So the next business, you might not have noticed that, but I switched the screen so that sphere of influence became a source of business. B&I networking became a source of business. Subdivision farming, we believe, is the center point of every realtor's business plan. Instead of paying 25 and 30 and 35 referral fees for someone else to produce leads, this realtor said, I'll spend my own money on Google pay-per-click. I'll buy my own leads from Realtor.com or Zillow, and I'll have a small lead spend every month, and that will ultimately be less expensive than paying a referral fee on each deal. And then, as the case with the other realtor, we had an eBowl FISBO system, which is our automated for sale by owner CRM that follows up on for sale by owners over the course of a 2, 3, 4, and 6 week cycle. But what we're going to talk about today, I think it could become important for you adding a $2 million a year source of business that brings multifamily into your operating environment, that you personally are gaining some expertise today that will help you along on listing, not selling buyers. Of course, you will sell buyers these properties, but really the focus of today is augmenting and adding to your listing inventory with multiple multifamily housing or some of these Airbnb sellers. So without further ado, I started to search in New Jersey to see what the multifamily home market was like. And you had duplexes, triplexes, quadplexes, Airbnbs all over New Jersey. I think there was 3,000 listings or so just in New Jersey. We went into Philadelphia, PA, looking at duplexes, triplexes, quadplexes, tons of them. And some of them are rehab projects, but some of them are move-in ready and qualify for special financing. You can finance up to 4 units with FHA. You can finance up to 4 units with VA. You could finance with conventional financing. And at the end of our session today, I'm going to introduce you to Catherine Parcells, and she's going to talk to you for a few minutes about some very, very unique financing available through Annie Mac Home Mortgage. These are non-QM products that have become the juggernaut for us to help families that couldn't afford to get into a quadplex, but they can because the rent of the other 3 units is covering the expense of ownership. So we're going to show you how that works. Look at this $269,000 6-bedroom triplex. You know, the math works on this one. A 235 duplex, you know, a 159 duplex, a 220 duplex. These are out and around Allentown, Pennsylvania. You go over to Coral Springs, Florida, where my son's been shopping for a $300,000 condo, and he's so frustrated. But I said, hey, why don't we look at this $1.2 million 12-bedroom, 8-bath home, use the non-QM products from Annie Mac Home Mortgage to qualify. He knows at 28 he could never qualify for 1.225 on his own. But when you add up the $2,500 in rent that each unit is bringing in, look at the payment that he's being quoted. He's being quoted at an $8,200 payment on a $1.22 million quadplex. Well, 3 rents at $2,500 a piece is $7,500. The third rent would push it well above the cost per month. Of course, maintenance is a headache. He's got to factor in his maintenance costs. There is no homeowners association when you own a triplex, duplex, quadplex. So you've got to save some money for roof and repairs. But these are properties that made millions and millions and millions of millionaires across the United States over the last 20, 30, 40, 50 years because those families bought duplexes, triplexes, and quadplexes for their first home instead of buying a single family home where they're going to carry all of the operating expenses. I do one more here in Norfolk, Virginia. You know, there was like some odd 70 or some odd homes. Oh, what I did is an analysis on this one just to show you. The payment was going to be $8,900, but all 4 units rent for $2,500. So that's $10,000 a month coming in rents with an overhead of $8,900, which includes principal, interest, taxes, and insurance. So he's got another $1,100 a month at today's rental rate to cover maintenance, or he can move into one of the 3-bedroom, 2-bath units. Maybe it's a lifestyle compromise. Maybe he says to himself, I'm willing to compromise today for a better tomorrow. I'm willing to live in a 3-2 quadplex, collecting rent from 3 of my tenants, and I'll pay the fourth tenant as my investment so that a couple years from now, I can rent that 4th one out Maybe rents have gone up a little bit. Maybe interest rates have gone down a little bit. Maybe I refinance it at $7,000 a month. Maybe I use one of Catherine Purcell's AnnieMax products to do an interest-only 10-year period, so I could pay $6,500 a month instead of $8,900 a month. But at the end of the day, guys, this is a sound financial principle for a homeowner to take a look at this little duplex for $295,000 for a young man who's shopping for a $300,000 condo that has a $600 HOA. This kid's getting beat up by a condo that he could never rent out for enough money to cover the PITI and the HOA or condo association fees. But at $295 for a duplex, he's got two sides that rent for $1,200 a piece. That's $2,200 today. Probably can go up to about $1,400 if he just pretties the place up a little bit. That'll bring in enough to cover the rent. And if I'm a 25, 27, 28-year-old family, especially if I don't have any kids and I'm not worried about where they're going to go to school right now, I can slip into this duplex for a year or two, live on the cheap, fix it up, make it pretty, and then that will be the vehicle that creates generational wealth for my family into my 30s, 40s, 50s, and probably well into retirement. So when it comes to multifamily, I want to point you to anniemacworks.com. I want you to tab down to the center of the homepage and look for our miracle letter. We've been using the Cash to Keys Buy Now, Sell Later program. We've also been using this special time of market condition that we're in, this really unique transitional market that we're in right now, to appeal to sellers that are experiencing high equity. So we say to that seller, we could sell your Norfolk, Virginia triplex for the highest price if you can close by October. So what we're recommending today is that you as a real estate referral partner start to send out about 100 of these letters per week. If you'll hand address with regular postage, finding multifamily homeowners, finding vacant properties that are sitting on high equity, finding Airbnb owners in your market, I will tell you, in my experience throughout the nation, you should be able to average one listing per 500 cent. So about every 4 to 5 weeks, you'd be taking an actual listing in the multifamily vacant properties or Airbnb owners that you're prospecting. We find that about 6 calls come in for every 100, but usually those calls are going to be conversational. And sometimes you can hit a nerve and say, hey, if I can put together some mathematics for you, show you what you'll net on this property, can I list one for every 500 cent? That is a sound multi source of business chart that could build you an extra $2 million a year in commission. So if I could spend $4,000 a year on direct mail and make back 60, 70, $80,000 a year in commissions, that is a sound business strategy. And we have seen as high as one listing per 350 cents. So if you have any questions, thoughts, concerns, or ideas that you'd like to share, reach out to your local mortgage professional at AnnieMac Home Mortgage. We've got the products to help you develop a multifamily magic business plan. We've got the financing available to help those families jump from a single family home shopper or a condominium shopper over to buying a triplex or a quadplex right now. And I have the opportunity to provide more today. If you think you know about non-QM, I promise you it has evolved dramatically in the last 12 months. Okay, there are products available for your self-employed borrowers. Some of the wealthiest consumers you've ever met live on a 1099 income or have multiple LLCs. They don't show a lot of income because they disperse their income among many LLCs, or a family trust is taking in most of their income. They don't show a lot of income. You're talking about the wealthiest people in the world that have multiple properties. They can't get a traditional mortgage. This isn't just about foreign nationals. This isn't just about like hard money loans. Non-QM has become a mainstream product for a physician to buy multifamily, for a an electrician to buy multifamily, for a young couple, maybe an emerging family who's never dreamt of owning a triplex or a quadplex, but to go ahead and get into a quadplex. One of my nephews bought a quadplex in Gainesville, Florida 6 years ago for under 270. Today it's worth upwards of 850, and he's been collecting rent on all the units in that Gainesville triplex or quadplex, whatever the heck it is, since he owned it. So you deserve more. We provide more. Let me introduce a lady that's going to solve some of the financing problems for your self employed, your emerging investors. We believe you deserve more from the mortgage industry, and Catherine Parcells is going to introduce you to some of the products and services that Annie Mac has diversified for this market condition and to help you take advantage of multi-family magic.
Thank you all for listening in today. As Russ mentioned, we want to open your eyes today into some alternative financing options that many loan officers, as Russ alluded to, are not yet aware of or have adapted this strategy of attempting to serve a lot of these underserved borrowers when it comes to that traditional product. So our whole presentation today is about partnering with companies such as Annie Mac and loan originators such as Russ and their team there that's going to be able to look at every borrower and every opportunity to open up that home ownership objective to that particular consumer. We're going to talk first about what is non-QM. We've used that term several times already. So let's talk about what exactly does that mean. And then we're going to talk about the market overview. What does this non-QM market look like? Who does and what does that non-QM borrower look like? And then we're going to go into all the solutions that Annie Mac and the team there are going to be able to provide borrowers outside of your traditional full doc, W-2, pay stub, tax return documentation that all of those traditional products allow. Now, we do welcome questions, so please do feel free to ask. We don't view that as an interruption. We view that as interaction. So at any time, feel free to speak up. Let's talk about what some of the characteristics of a non-QM loan is. One, it expands debt ratios higher than what agencies generally would allow. It goes to a 50%. Non-QM also allows some different terms in relation to the length of time a borrower can finance. Non-QM offers a 40-year term. We know there is some affordability issues in the market. You see it as agents all the time. So that 40-year term is certainly going to assist. We also have interest-only features. So as Russ alluded to, he is himself an investor. And as we know, investors are all about what? The cash flow of that property. So that interest-only feature is very attractive, especially to the investment community. There is no PMI or private mortgage insurance for the agents who are not aware of what that is on a traditional or conforming loan. Anytime you put less than 20% down, you're required to buy this insurance. It doesn't insure the borrower, it insures the lender. Well, in the non-QM space, that doesn't exist. The borrower can indeed go put less than 20% down and not have to pay that private mortgage insurance. The highest use and the biggest characteristic of the non-QM product that's utilized nationally is the flexible income sources. As you heard Russ talk about being a 1099 borrower himself, and you as real estate agents, you're 1099 borrowers too. That often does create a problem. We all like to take that IRS tax code and use it to our benefit, take all those legal deductions that we can, net that income down, and that often presents a problem not only for the 1099 borrower, but for investors as well. So we're going to talk today all about these flexible income sources to help these borrowers qualify. These are manually underwritten loans. What does that mean? When we do any other type of loan, your government loans, your FHA, your VA, your Fannie, your Freddie, your conforming loans, they all get run through a automated system, AUS. That system analyzes the risk of the borrower, gives the originator an approve or an accept or a refer, right, or ineligible decline. Here you actually have a human being analyzing the risk of that particular borrower. So it affords some common sense situations to take place. And it also offers underwriters to look at the totality of the borrower in their certain circumstances and often make exceptions outside of what traditional guidelines are. Now, non-QM is expanding, so we're glad you're listening in today. You are going to hear more and more about non-QM. This is the one area of mortgage originations that is growing. It is expanding. It is supposed to double this year. Why is that? Well, first off, we have more self-employed and 1099 borrowers in our country than ever recorded in the time that number has been tracked. So that would make sense that they would need more solutions and this product would grow. The other reason non-QM is growing is because originators such as the AnnieMac team, they are adapting a non-QM strategy. They have taken this time in this constricted market to educate themselves on other products to help qualified borrowers achieve their home ownership dreams. So we're happy to see that occurring throughout our country. The other reason we see non-QM growing is because once you're able to say yes to a borrower that somebody else told no based on their tax return, they're certainly going to refer. They're going to talk about that. Like borrowers hang out with like borrowers. If I'm self-employed, I know more self-employed borrowers. So indeed, it strengthens our client base and our referral base. So non-QM is really here serving that underserved borrower. I do want to talk about the credit quality for those agents who may be listening and you went through that dark day of '08, what we may deem as that old subprime market or that foreclosure crisis. I want to fast forward and talk about what non-QM is today. It is not that old subprime market. These are responsible loans. There is ability to repay that has to be met. And we're dealing with a well-qualified borrower. The average FICO nationally, that's what WA means, weighted average, nationally is 742. I think by anybody's standard, that is a solid FICO. The average LTV is 70, meaning what? They either have a 30% down payment or if they are refinancing, they got good equity. So these are borrowers who are qualified. Their average debt ratio is 33%. So why are they here getting a non-QM loan? 51% of the time, it's simply because that borrower is self-employed. They are the highest user of the non-QM product and the highest demographic of borrower in our country being underserved in the traditional market. So we're going to talk a lot today about those solutions for that self-employed. We're also going to talk a lot today about the investor. They are the second largest group of underserved borrower, and these are very active borrowers. This is a very consistent borrower, more insulated, if you will, to the rising rate markets. Statistics from the IRS say that the consumers claiming rental income has increased every year since 2006 by 7.3%. These rates are not stopping the investor. They understand cash flow, and they are very, very active. So we'll talk a lot today about how AnnieMac and the team is going to be able to serve that investor outside of those traditional products. Let's talk first about the bank statement program. What is this? This is a program for the self-employed borrower who would like to use the deposits in their bank account in lieu of using their tax returns to qualify. So they've taken all their legal deductions. You get to that net income and it creates a problem qualifying for that property. Well, utilizing the deposits in that bank account to come up with that borrower's usable income will net that borrower often more income and certainly can get them to the price point that they'd like to achieve when they're purchasing their properties. There is no IRS documents needed, so you don't need your tax returns to be submitted. You need 12 or 24 months of personal or business bank statements. Most of the time, 12 months was sufficient. Only time the team really asks for 24 is for a seasonal business to get a better average of that borrower's deposits and income. Now, we're going to calculate that income in advance, just like we would any other loan. We'll get that income calculated for you within 24 hours so that we know within 24 hours of receipt of those bank statements what that usable income is. Just like we would on any other loan, we're going to verify that borrower's income before we tell them what their purchasing power is. Now, you can still go with a lighter down payment. 10% down is the minimum. As we saw from the opening slide, most of these borrowers have a substantial down payment, but you still have that option for that 90 loan to value. Loan amounts go as high as 3 million. So if you're an agent who has those jumbo listings, those prime jumbos are sometimes even more stringent to qualify for than an agency loan. They have to higher allowance for that borrower's debt structure. They usually require higher reserves. They are all full doc. That self-employed borrower who has a great tax strategy has no other way to qualify for that jumbo product without the tax return. So here, all the way to that 3 million, you could help that self-employed borrower on those jumbo properties. If you are in the non-warrantable condo market, you have those listings in the non-warrantable condo arena. All the features we show you today and all these income solutions we show you can also be used for that non-warrantable condo. So great opportunity there to have another option or outlet for that type of financing. These do go to 4 units and, of course, all your traditional single-family PUDs, townhomes, etc. But we wanted you to be aware, condos and non-warrantable, as well as 4 units, the borrower can use this feature. Now, whether they're purchasing that property for a primary, second home investment, if they're self-employed, this is a viable solution outside of that tax return. We also run into self-employed borrowers who have dual sources of income. I own Cat's Landscaping, and I also own 3 rental properties. I don't want to use my tax return to qualify. If I've got dual income, I probably have a very good tax strategy, right? So you have that ability to document the rental income via a 3-month bank statement. So once again, more flexible sources for investors. We have a second option for that self-employed borrower that may want to go a little lighter on the documentation. It's called the 1-year profit and loss. We simply get the borrower, instead of their tax return, in lieu of the tax return, they get a third-party prepared profit and loss. We are going to look at the net income off of that profit and loss when we're qualifying that borrower. We do that in lieu of the bank statement feature, in lieu of a tax return. It is a separate option that the team will look at as you send your referrals over there to Annie Mac. Remember, no IRS tax documents needed. Loan amount goes here to 80. If I'm using this lighter, just my P&L to qualify, then I need to have a larger down payment. Doesn't matter again, owner-occupied second home or investment. If I've got a self-employed borrower, here's yet another solution the team can look at. Again, all the way to 3 million. Still can do your non-warrantable condos. As we've mentioned, every alternative income feature across the board on that non-warrantable can indeed be used. There is
Catherine,
another,
did you just,
yes,
Catherine, do you mind if
yeah,
I interrupt?
no,
Did
not
you
at
just
all.
tell me that my accountant would prepare a P&L and submit it to you, and then that would be my proof of income? I hadn't heard that before. Is that what you just said?
That is correct. And this is a feature that we just rolled out on April the 19th. So it gives borrowers often who may have more sporadic deposits, right?
Mm,
Um, and don't want to go through that 12-month bank statement feature. I've got a second option, right? Now you can
mhm.
ask that borrower for that 1-year P&L. We'll do the math on that net income and divide it out and utilize that as income. So it's a lighter documentation than the 12-month bank statement, and for some borrowers may work better. So the beautiful thing here is the originator will be able to look at each individual self-employed borrower and decide what solution is going to be best for that particular business.
Amen. Thank you.
Thank you for the question.
Mhm.
All right, let's go for another solution. Now, asset utilization is a feature that can be used across the board. I don't have to be self-employed to use this asset utilization feature. Asset utilization, what this is it's going to give the originator the ability to use the borrower's assets as income without the borrower having to be of retirement age. They can even use their retirement account as income. The borrower doesn't have to liquidate that asset. We all know right now moving money around is a little tenacious. So these borrowers get to keep their assets intact. The originator's just going to ask them for all their assets, and we can use them to solve various issues for borrowers. The first issue we could solve for a borrower utilizing their assets as income is if I have a debt ratio problem. Remember, we said non-QM can go to a 50% debt ratio, but what if I am at 53? Instead of asking that borrower to put more money down or, heaven forbid, purchase less of a price, right, or pay off that truck loan, all those other solutions that could solve a debt ratio, the loan officer can gather the bank statements on the borrower's assets, even retirement accounts, give the borrower credit for the balances, and divide it out by 84 months and add it to their other income without the borrower having to do anything but turn over their asset statements to the loan officer. The other way asset utilization can be used is there are a lot of borrowers who have employment challenges or don't necessarily meet the employment requirements. When we look at mortgages in general, borrowers have to have a 2-year work history. Doesn't matter what type of loan they're getting, right? They have to have a 2-year work history, unless, of course, they're retired. If they're self-employed, they still have to be self-employed for 2 years. What do we do with those borrowers who can't meet those guidelines, but they have assets? They have heavy assets. Asset utilization can be used to negate any employment verification, income verification, or any debt structure looked at for the borrower. Now, mind you, they do have to be someone with, sufficient assets, and your loan originator will know all that math. The point being, it's yet another way originators will be looking at these borrowers and every possible solution to get them to that home ownership that they're desiring. So FICOs here are 660. So remember I said in the beginning that these are responsible loans. Um, they are. That's why there's a minimum FICO requirement, right? Now, 660 is not perfect, but it's a mid score. It's a good score, so they can use uh, that asset utilization feature. Again, up to 3 million. Assets don't have to be liquid. My retirement account that I can't get at, I can use that as income without having to liquidate that. Doesn't matter if I'm owner occupied second home or I'm purchasing that as an investment. So again, think of all the solutions in that second home and investment category, right? We know Fannie and Freddie have tightened or had some concerns, if you will, in that second home or investment area. So these products open up a lot of opportunity for that particular occupancy type. The last feature or solution we want to talk about is debt service coverage ratio, better known as a DSCR loan. You may have heard of it called a cash flow only loan. What is this DSCR? This is a feature for investors where we don't have to verify any employment. That the employment isn't even asked where they're employed. We don't look at any income. There's no income documentation at all that the borrower has to produce. Therefore, we wouldn't look at the borrower's personal debt structure. Your ability to repay is based off of the cash flow of the subject property. So the concept here, can the gross rental income that borrower could bring in on that property cover their proposed payment by three-quarter or higher. On purchases, that borrower does not have to cover their payment by 100% or more. That would be, of
This is
course,
Catherine, this is probably
yeah.
the most interesting product that I've seen. I'm with a lot of let's call millennial ambition, right? I want to get into multifamily. I want to get into multifamily, right? And I show them a triplex that brings in $5,000 a month in rent. Um, but in the past, I couldn't qualify them because let's say they make $90,000 a year and they already own a single family home. They're trying to buy a triplex and there's no way it just won't work. This product would use the $5,000 a month that's historically been coming in on that triplex to qualify for the loan.
Yeah, let me show you how the gross rental income is calculated. And I think you made a really great point in reference to why we see that uptick, right? That 7.4% more year over year of consumers are reporting rental income. If we think about the fact that, many corporations, there's no longer that retirement, right? That pension. And so many folks are looking at real estate as a retirement plan, right? And the millennials are getting in early, and I think you make a great point about the demographic of borrower that could use this. So here's how we are going to look at the rental income on a purchase, or a refi. If there's an executed lease agreement on that property already, we're going to use lesser of the lease agreement or the market rent from the appraisal. For the agents out there who may not be familiar with these forms, anytime an originator does a property, finances a property that is being utilized for investment purposes, they ask the appraiser for these addendums. What do these addendums do? They tell the lender what the average rents on comparable homes in that market are. So we're going to use lesser of the lease agreement or that market rent from the appraisal. If there's no lease agreement, you simply use whatever that market rent from that appraisal is. Now, the key here is in the non-QM world, borrowers get credit for 100% of that income. In the agency or conforming world, loan officers have to cut that income down by 25% to allow for what the agencies deem as a vacancy factor, meaning they don't believe that this property is going to be rented all year, every year, that 25% of the time it's going to be vacant. So they cut that income by 25%. Here you don't have to do that. You get to use 100% of that calculation. There is also an allowance for that property that may be leased. And if the lease is a higher monthly rent and you need that higher monthly rent, you can document from the seller, or if it's a refi from the borrower, that they've received the most recent rent from that higher amount for the last 3 months, and then you can even use that higher amount. So again, these are all details as agents that your originator understands. They're experts here in these products, and they're going to be putting the pencil, if you will, to your clients that you send to them to make sure they explore all of these avenues to qualify these borrowers. You could even ask to do preliminary data on your listings, right? Rent.com, Trulia.com. Ask the originators for a proposed pity on your listings. It may help to offer this in some of your advertisement for that property and open up more investors to the listings that you currently have.
Can I ask you a quick question, Catherine?
Yes.
So let's say it is a vacant duplex. It's never been rented, just hypothetically, or even a duplex. Let's just go with that. It's vacant. There's no leases in it, but the appraiser says they're going to rent for $2,500 a side, but there's no renters in it now.
You, you,
How does that calculate in the real world?
you use the market rent from the appraisal. If that appraisal says each unit is $2,500, each unit gets $2,500 rents. Yep. That's
Okay.
all you do. Whatever, if there is no lease agreement, then meaning it doesn't matter if it's, when I say no lease agreement, that could encumber a lot of things, right? That property could be vacant. An investor could be buying somebody's primary residence. An investor could be buying somebody's vacant home. They could be buying somebody's second home, right? So when we say there's no lease in place, meaning could be vacant, simply could be it's
Yeah.
somebody's buying somebody's primary or their second home. So you just go by what that appraiser says.
Got
Yeah.
you.
Mhm.
Interesting.
Yeah, remember they don't have to supply any employment, they don't have to supply any income, and we don't look at their debt structure. We're simply looking, does that calculation from this gross rent cover their pity depending on their loan amount by either 1 or 3/4?
These are typically 20% or 30% down purchases.
These are a minimum. When we look at our DSCR loan, 80% is the max loan to value. So an investor would need 20% down.
Yep.
They do need a minimum of a 660 FICO. So again, these are responsible loans. We all lived through '08, right? We need a good FICO to negate any employment income or debt structure. Loan amounts here go to 2 million. So still open in that jumbo territory. You can still do the non-warrantable condo. Often it's the investor who makes the condo non-warrantable. So great opportunity there. We even will help first-time investors. So if I have no landlord experience, and this is my first, as Russ alluded to, getting a lot of phone calls from millennials perhaps wanting to enter in and become investors, it could be their first investment property. They can use this to qualify. They just need a little lighter down payment. There's no cap on how many properties a borrowers can have financed. For those agents who may not know, your conforming products, your Fannie Freddie products, they limit borrowers to 10 financed properties. Once that borrower gets to 10, the conforming world says, sorry, we're not going to help you anymore. There is no cap here in the non-QM. It's unlimited finance properties for the borrowers. And they also don't need additional reserves on all the additional finance properties they have. In the agency world, they do. So it's very much a lower dock, lighter way for an investor to qualify if indeed they can't be served with that agency loan. Any other questions on that?
No, I just think it's a very exciting time in the mortgage business with a products like these are opening up. All of my realtor friends were self-employed, right? And we'd be like, how the heck do we get into some of these properties with this challenge? But I applaud Annie Mac for bringing you in to educate our originators to help our realtors just fund more properties. It's a great time for us to expand our products, but it's also a great time for our realtor partners to be able to reach out to millennial ambition investors, or even guys like me that felt like we were locked out of multifamily in the past. So it's a fantastic opportunity, and I appreciate your time on it.
Well, we thank you all for having us. We thank you all for tuning in. And again, please utilize your Annie Mac originators and team over there. They really will do their very best to serve these underserved borrowers and think outside of all those traditional products everybody else is selling, right? So again, thank you, and we hope you have a great day.